top 10 factors to consider when you think you might be ready to transition your agency. All right, first thing we're going to look at is, what if that business is owned by the agency? So let's say you're the agency principal. Do you own 100% of that business? The answer is yes or no. You should have employment agreements with every single one of your employees. So I don't care if they're licensed or not, you should have an employment agreement. If they're working for your business, it's poor planning is the biggest effect and factor into an agency's valuation. We are focused on solving a unique problem in the independent agency system, and that is small to mid-size agencies have never really had a good outlet for getting a valuation of their agency and then getting thorough advice and consultation around, what should I do with my agency? How do I improve the value of my agency? If I want to sell my agency, what's the process around that?
This episode of The Insurance Dream is brought to you by
Insurance Professionals is the aggregator unlike any other. You own your book of business 100%. You pay no sign-up fees, monthly fees, or exit fees. You have direct logins to the nation's top insurance companies, and you have the ability to quote and bind directly on the carrier's website. Insurance Professionals was built for insurance agents by insurance agents. Come see what makes us America's favorite aggregator at www.becomeaninsurancepro.com. Again, that's www.becomeaninsurancepro.com.
All right, I am here with Jeff Smith of IA Valuations. Jeff is one of the consultants over there. I was actually at a conference in Orlando, Florida, a month ago, and Jeff was doing a presentation. We had our merger and acquisition series that took place here a few months ago, had some fantastic guests, and I was sitting through Jeff's presentation. I'm like, this has got to be the grand finale wrap up of the M&A series that we put on, because there was such great specifics that were given. And it was just a lot of data on what agency owners can actually practically do, talking about all sorts of different, measurable items and what you can do to increase the value of your insurance agency. Jeff, thank you so much for being here.
Happy to be here. Thanks so much for having me. I'm excited to be a part of this and help maybe put some additional closure on your series on M&A.
Yeah, for sure. So first, give us a little background to yourself and your business and kind of how you guys got going and the clients that you generally serve.
Yeah. So in terms of myself, I'm a lawyer by trade or by profession. I've been in the P&C business services side of what we do for independent insurance agencies for the last 9 years. Prior to that, I was primarily focused on the health insurance side. So I've been in and around insurance in some manner the last 17 years of my career. And what we're doing now is around IA Valuations is we are focused on solving a unique problem in the independent agency system. And that is small to mid-size agencies have never really had a good outlet for getting a valuation of their agency and then getting thorough advice and consultation around, what should I do with my agency? How do I improve the value of my agency? If I want to sell my agency, what's the process around that? There are a lot of M&A firms out there for insurance agencies and brokerages, but they typically play in a much larger space. And what we know from the constituency that we serve is that most agencies reside in the $1 million in annual revenue and smaller. In fact, 80% of the clients that we serve are just that. They're $1 million or smaller, with the average being, $600,000 in annual revenue. So what we found was, again, that constituency was not being well served in the current marketplace, because the transactions, admittedly, they're a lot smaller than the ones where you're trading at, a multiple of $5 or $10 million. our folks just, typically aren't there. So we wanted to provide a good service, a quality valuation report, and then an ongoing engagement opportunity for agencies that were interested in learning and understanding not just what the value is. I don't want to see the number, but I want to understand what are the tools and tips and the tricks I need to implement in order to improve the value of my agency.
Yeah. Well, and that's perfect. I mean, that was the kind of stuff that when we sold our agency, we could have used that 3 years in 3 years in advance. So, and we didn't know we were going to do it. It kind of happened upon us. But this is perfect for the agency owner that's out there. They know they're going to be retiring. They know they want to have an exit plan. And you know what I mean? What things can we implement to make sure we're maximizing? Because I mean, a lot of folks, their insurance agency is the biggest asset that they own. And so, maximizing that, especially going into retirement, it's 100% key to success. So walk us through, like, what's the number one thing? Like, what's the biggest thing that you see playing a role in the valuation of the agencies that you serve?
So let me start here. Number one is it's poor planning is the biggest effect and factor into an agency's valuation. And so you mentioned that you didn't know you were going to sell your agency, and most agency owners don't know that. And the recommendation, you always hear this line is operate your business like you're going to sell it tomorrow. And that's good advice, but it's I don't know that it's real practical. And so what we've tried to do again is try to get down to practical advice, and that is start to plan 3 to 5 years in advance when you believe you may think you might want to sell your agency. And so we've done a lot of things. Like we've come out with a series of, kind of like what you're doing in terms of helping agents learn, is we come out with a series of top 10 factors to consider when you think you might be ready to transition your agency. So not even telling you that you might be ready. This is just way out on the horizon, but you start to look through these top 10 factors. And if they start to click, and you start to think, maybe I'm getting closer, at some point there's a tipping point, whether you're at a 7 or an 8, you have to start to plan for it, because to your point, well-planned agencies they're going to be higher in value because you can fix a lot of these factors. And that's like what I'd love to dig into today is maybe these risk factors in an agency's valuation that an agency can fix. It's just like staging your home in a lot of ways. If you're going to sell your house, you do, hopefully you do something. I guess in this market you might not have to, but now that interest rates are rising and
probably changing.
Yeah, I mean, there might be a little bit more competition for home sales. Like you might start to think like, maybe I should clean out that closet. Maybe I should declutter. Maybe I should have someone come in and professionally stage this home so it looks better and I can get a little bit more value out of it. That's what you want to do as an agency owner, is at least contemplate that for a minute. If you've not run your agency like it is for sale, then do that and give yourself 3 to 5 years, because these things are not quick fixes overnight. I mean, They just are, you don't get any of these risk factors out of your agency or improved overnight. It takes time.
Well, that's what makes it valuable, right? So,
exactly.
So where would an agency, like, let's say that I came to you and I had a 800,000 revenue agency, like what would be the very first piece of advice you would give me, or very first thing we would look at together?
All right. First thing we're going to look at is, what if that business is owned by the agency? So let's say you're the agency principal. Do you own 100% of that business? The answer is yes or no. So yes. A lot of agencies operate with producers that are in 1099 independent contractor relationships, and they have different structures around whether or not they actually own that business. If they don't own that business, that is a huge red flag and a huge risk, because ultimately you don't have the value of that. So if you have an $800,000 revenue agency, but 200,000 of it is produced and owned by, in a shared services arrangement, owned by somebody else, that's really not yours to sell. And contractually, it may say, hey, all the contracts go through us. We own this. But there's a deeper dive of discovery that you need to do whether or not you actually own it. So again, I mentioned my trade and profession is legal before, diving deep into insurance. You got to look at the contracts. What does that producer 1099 agreement look like? Do you have employment agreements with every single one of your employees? That's what every prospective buyer, it's one of the first questions they're going to ask you. Yeah. They're going to ask you, I mean, the litany of questions is say, can we see last 3 years of your P&L, last 3 years of your carrier production reports, last 3 years of your tax returns. They're going to ask for, background on your employees. But one of those key questions is do you have employment agreements? Because you're at risk. I mean, it's a big risk. Non-owned books of business and also agencies without employment agreements are at a heightened risk.
Yeah, we had a guy several episodes back now, but earlier in the M&A series, who said that one of his clients went and told his staff, hey, I'm selling the agency, and the gal that was his office manager, and I'm probably butchering this story, so we'd have to go back and listen to it, but the gal that I think was his office manager said, basically, no, you're not. Because, I don't have a non-compete, and I don't have, what I mean? I have the relationship with all these customers, also start my own agency. So I want you to sell to me. And clearly when you only have one buyer, like that obviously impacts the price, right? So having the agreements in place, that's huge. Now let's say real quick, just kind of going off on a little bit of a rabbit hole real quick. Let's say that there's an agency out there that does not own their book of business, right? The producers by and large own the book of business. How does that impact? Because I mean, I think the rule of thumb, if I'm correct, and you know more about this than me, but the rule of thumb is if you're under $1 million in EBITDA, that you're running on different multiples than over $1 million in EBITDA, right? So is that true?
It is. I mean, it's okay. We can call it that. Sure.
Okay.
Yeah.
So let's say that you're running under $1 million in EBITDA, and you really don't own your book of business. I mean, what kind of, because, normally, like, and I think, again, we're going to rule of thumb here. Anything over $1 million, you're potentially anywhere from 3 times, 4 times up to like 7 or 8 times your EBITDA mark, right? Or at least that's what it was. And under $1 million, maybe you're looking at like 2 or 3 times. Is that a pretty fair statement?
Well, so, EBITDA, your EBITDA multiplier is going to be a lot higher than your annual revenue multiplier. So typically what we tell folks is like, look, your multiple, the multiple of revenue for your valuation is an expression of value, whereas the EBITDA multiplier for your valuation is a calculation of value. And your EBITDA multipliers typically in the insurance agency space, what we see is somewhere between 6 and 9 are the average transactions. Your revenue multiplier is going to be somewhere between 1.5 to 3, maybe 3.5. Like it all depends. Like if you're in Phoenix, Arizona, or let's call it, you're in Scottsdale, Arizona, nice area, it's booming. You've got a great business, you're growing, you've got young people in that business. You've got young ownership, you got great carriers, you've got really good loss ratios. You have all of it going for you. You're 70% commercial lines, 30% personal lines. You're going to your platform agency of a couple $1 million in annual revenue. You're going to trade at a much higher multiple than, an agency that's out in rural Arizona with limited markets, with higher losses, a generational agency that doesn't have young people. So there's a lot of factors. I bet that's probably what you've heard a lot in these series is that there's a lot of factors. But I'd love to dial in specifically on some of those and help people learn and understand like what has the biggest effect. Because I think we've already uncovered 2 of those. So your $1 million agency, you've got a lot of it that you don't own or some percentage of it you don't own. People aren't going to pay you for revenue that you don't own. So
what kind of hit are we looking at though? Like on that, when you got these people out there and a lot of our audience, like we've got, a lot of the kind of the, typical insurance agent, in their 40s, 50s, 60s that listen to this show, but we actually have an audience that is, late 20s all the way up to 40. And for those folks that are building these producer agreements that are going to kind of, steer their agency for the next 15, 20 years, what kind of difference are we looking at in this market, right? Who knows what's going to be in the future, but in this market, I mean, are you looking at like, you can't sell your agency, or are you looking at like, maybe instead of, a 2 to 3 time revenue multiple, you're looking at like 1?
Yeah, it could be. I mean, I don't know that it would be that draconian in an effect, but it could have a significant hit. So
Big
let's
hit.
just take that example of you're $1 million annual revenue agency,
Sure.
and you only own $600,000 of it, and $400,000 is owned by producers that you have agreements with that use markets of yours, and you have some shared service administrative agreements with. Um, yeah, in all likelihood, someone's not going to probably pay you for that. They might negotiate separately with those producers, or they might negotiate with you collectively as a whole, but with the expectation that the producers have to come along. So again, it will go back to those agreements in terms of what you actually own, because that will determine what the sellable asset is that you have.
Sure.
That's why it's so important. So your 25 to 40 audience, look, take the time to set up your agreements the right way. I mean, the best thing about being an insurance agency owner, an independent insurance agency owner, the best thing about it is you have the golden carrot, and that is ownership. And I get it. Like, that's a hard thing to part with, but you're doing it, whether you're doing it thoughtfully or you're doing it through, producer agreements where someone else owns the book of business. Be thoughtful in terms of how you set up your first agreement with anyone you're bringing on board. If you set it up where they're an independent contractor and they own the book of business or a percentage of the book of business, discount that from your annual revenue that you're trying to tell people that you own, and that's a sellable asset, because it's technically probably not.
Sure. So do you guys help with employment agreements over at
We do. Yeah, we have template agreements that we share with folks.
Sure.
We'll help them work with them. We don't offer specific legal advice to agencies, but we provide guidance, and then we'll set them up with attorneys. But yeah, we do. It's the first thing that we encourage agency owners to do. If they're thinking about transitioning, we tell them, get every single one of your employees to sign an employment agreement. And the employment agreement has a non-compete, it has a non-solicitation, and a non-piracy agreement. And I know all those things sound very similar. They're not. They're very distinct and different in a lot of ways. And not in a covenant, also, confidentiality agreement. So you want to have all of those components in place before you take your next step on doing anything. Yeah. It's like that agency owner that you shared, boy, what a burn. I mean, that hurts.
Yeah, that's tough. I mean, that's really, so let's say, okay, we're either addressing or we've got the producer agreements handled. What next? What do we look at? Number 2.
Okay, so you got that. So I'm going to walk you through a couple things here.
Sure.
And they are kind of in I don't want to say order of importance, but they're meaningful in a lot of ways. So the next thing you're going to look at is the age and complexion of the book of business. And that can kind of be looked at in a way, the concentration of the book of business. So if there's 3 under that category, no, there's 2. So age and complexion. So you mentioned it. Are you heavy personal lines, heavy commercial lines? That is really, really important. I know in the agencies that we work with, what we see on average is 52% of the agency's book of business is commercial lines and 48% is personal lines. I'm not suggesting that's always normal, but if you're a 95% personal lines agency and a 5% commercial lines agency, your multiples right off the bat are going to be different than what the industry averages are, because personal lines, as we all know, is subject to greater commoditization. It's subject to increasing competition, and it is much more mobile. It pays a lot less, and so there are a lot of variables that make that business a little bit more concerning today and into the future. Whereas commercial lines is a little more sophisticated. The commoditization of it it's happening in the BOPs and in small commercial, but middle market is still a little, it's not. And then obviously large, sophisticated, commercial is not, it's really not ever probably going to be touched. I mean, it could be. I think technology will aid it, but it will always have an advisor component and role to it. So that's going to be really important. The age as well. I mean, if you're a heavy personal lines agency and you have a client population that's aging, their risks are going down as well. So understanding the complexion and the age of your book of business is critically important. Depending upon the sophistication of your agency management system, you might be able to get a lot of those metrics and a lot of that data. If you don't have it, what we go through with some clients, because some don't even have management systems, and there's nothing wrong with that. I mean, it's a challenging way to do business into the future, but you should have some system of record for your agency. If you don't, what we go through and say, hey, all right, you have to complete this Excel spreadsheet. We want you to go through and get every client name down here. We want to know what policies they have with you, what the premium is on the policies, how long they've been with you, what their age is, all of that, so we can understand. You look at the complexion of that book of business and understand what are the risks within that book of business, because again, a seller's going to want to look at that or a buyer's going to want to look at that in their due diligence process.
Yeah, absolutely. So we're looking at the producer agreements, we're looking at book ownership, and now we're looking at the mixture of the book, the age of the clientele, what kind of policies we're working with, things like that.
Yeah.
Okay. And is there, so you said you want commercial, you want a good mix of commercial versus personal. We don't want to be all personal lines. We want kind of not a super, you don't want to be insuring all senior citizens, I'm assuming. Is that pretty fair to say?
Yeah, that's fair. Yeah.
Okay. So what are we looking at next?
Okay, so next you're going to look at a couple factors, but let's start with this, client concentration. So your clients, again, let's say you are that, you have a little higher commercial lines book of business. How much of concentration is in your top 10 accounts? So if you have a couple of large accounts that boost that up, there's going to be a lot of risk in that. So you want to know, all right, what are the risks? What are the vulnerabilities of that client leaving? That client being bought, and M&A activity affecting them, the industry that they're in. So understanding the client concentration. In addition to that, carrier concentration. So how many, what's your lineup of carriers and what percentage of your business is with the various carriers? So are you a pseudo independent agency operating as a captive in a way where you've got 90% of your book of business with one carrier and then you've got Progressive for the rest? Like if that's what you are, like that's going to affect your value unless you find, it only affect your value in an external sale because it will limit your options. Options are good. Like if you can get more options, it's going to get you more interest and more offers ultimately, which is hopefully going to increase the value of your prospective sale. But if you have one lead carrier that has most of your business, you're only going to be able to go to those other agencies that have that lead carrier that you're going to benefit them. So that's those are the next factors. And then after that, I would look at generational health. So we mentioned, employment agreements with the staff, but like, what about the staff and the owners? So are you an owner that's going to stay on and transition the book of business? Is it a plan to stay a year? Is it a plan to stay 7 years? So let me give you an example of some situations that we've seen in the past. Agencies where they sell and they transition the agency owner transitions out within a year. I would say our experience has been they typically sell for less than if you have an agency owner that's willing to stay for 3 to 5 or 7 years. Like there, you have stickiness to that book of business, and someone's going to be willing to pay you more because you are willing to stick around a little bit longer to ensure the continuity of that client in that book of business. Also, your staff. If you have a staff of 6 and they're all over the age of 55. That's going to set off some red flags. There's no age discrimination here by any means, but it's a reality of they're going to, people who are closer to retirement are going to have less tenure to work in your agency versus those who are maybe in their, earlier in their career and have to work. Yeah, they have to work for another 30 years. And, the best example is, and Abe, we talked about it in the setup for this, is we did a study of, we've done a couple hundred valuations of independent insurance agencies, and we did a study. We looked at the agency's owner age. And what we found is as agencies' owners' age gets greater, the value of their agency goes down. And the factors that affect it most are the growth of the agency plummets. It just drops like a rock. So when you have agency owners in their 30s and 40s, while the volume isn't there, the growth is astronomical in comparison to agency owners in their 60s and 70s. And then 50s, it's kind of right in the middle. I mean, you look at it, it is a direct line down. Same thing, their profitability margin, it goes way down. And it's because as you get a little bit further into your career, the business starts to become a lifestyle versus when you are earlier in your career, you are running it like a business. You're running it very lean. You're looking at every single cost. Whereas you're a little later in your career and all of a sudden, you know, your cars are getting a little more expensive. They're running through your business. You know, you might have the whole family on your cell phone plan. You run your country club through there. Well, in your 30s and 40s, you probably can't afford that stuff, really. I mean, some of it you can, but I mean, you mentioned it. You're hungry, like you're hungry because you don't have anything to eat, like you're trying to go out and get it. And so those are big factors. So again, growth goes down. Profitability goes down, and ultimately value goes down. And so the study that we did, it shows all three of those metrics, which ultimately it's the EBITDA multiplier that we saw go down significantly. On average, agency owners in their 30s and 40s have an EBITDA multiplier of a 6.8. Agency owners in their 60s and 70s have a 6.2 and a 6.1. What does that spread mean? Well, if you take an agency, so we did it, we took an agency of $600,000 and we did a very similar EBITDA comparison, but we changed the age of the owners and we put these other factors in there and ultimately found that the agency value was somewhere between $200,000 to $300,000 difference.
Yeah.
Now, I don't know about you, but like that's a fair amount of money to me. Like that's a lot of money.
Yeah. That's nothing to sneeze at. That's for darn sure. I mean, that's and I was going to ask, is the multiplier different because you answered it, but is the multiplier different because the growth is different, or it's just the age is different? So, well, I guess maybe you didn't really answer that part. So is it, if you take two identical agencies, both growing at the same trajectory, both, all things equal, one owner's 65, one owner's 42. I mean, what is that valuation? Excuse me, that valuation is going to be different. And you're saying, because I mean, obviously the people that are buying these things, like, they're not dummies, right? They're looking at like industry wide. They're looking at the same kind of data that you looked at. They're running numbers like which ends up being profitable, which doesn't. And the ones that are statistically likely to end up being more profitable, you pay more for. So is it all things equal, the 62-year-old gets less than the 65, 42, whatever I said? Is that the case? Or maybe are they pretty similar when you're panning out at the end? It's just the growth factor that statistically slows down for the folks in their 60s.
Yeah, that's probably the biggest driver of it is the growth factor. But that being said, all things equal, I think it's a deeper dive, and it will be dependent upon that agency. But look, we've got a significant workforce shortage right now. I mean, we are in a talent crisis in the just generally speaking, across this country, we have a talent crisis. You take the insurance industry, we have a very big talent crisis because of the age of our, the age of the insurance population is growing, and we need a lot of jobs filled in the industry. Then you take the independent agency system, and you know that the average age of owners is 59. Yeah. All of a sudden, you got even a bigger crisis. So, like, it just compounds. So, my point would be this: if you're a buyer and you're looking at buying an agency and you're buying it from a 65-year-old, what is the first thing you have to do? You have to find someone to run that agency, that location, unless you're folding it all into something. And if you are, great, but then you still have to have someone manage that book of business to manage those clients. So you need that 65-year-old to stay on to 2 to 3 to 4 years, so you can train another producer to come in and take over that book of business and or the management of the agency. Whereas if you have a 42-year-old and you buy that agency, you got a built-in plan. Now, who knows? Like, why is that 42-year-old selling? Is it because they want to get out of the business? Like, because they inherited it from their father or mother and they're just tired of it, they want to be done? If that's the case, again, that will have an effect. So everyone's story is a little bit unique. So I don't want to be naive and tell you like it's one way or the other. But I know just from, again, if you're looking at demographics on paper, it's gonna be a little bit more intriguing to know you've got someone who's got 20 plus years left in their career where they probably have to work, because it's unless they run in a mega agency, it's probably not a complete exit event for them.
Yeah. So we've gone over a lot. Are there any other big stones left that we need to look at as far as valuations go?
There are, and again, this is on the presentation that we were a part of together.
Yeah.
This is on page 2, but it's not necessarily of less importance, really.
Okay.
Growth rates are really important. I've already mentioned those.
For
Retention rates are really important. Profitability of the business is really important. I mentioned technology systems. Like, it's not a death knell that don't have any technology in your agency. I wouldn't
maybe for
encourage
growth it is though, right?
But for growth it is,
Yeah.
and I think for future growth it is. So I wouldn't encourage anyone to operate that way. I would seriously consider, like, if you don't have any technology and you don't plan to implement any, like, it might be, again, that's one of those 10 factors I mentioned around, it might be time to contemplate, if you don't want to have an active relationship with technology in your business, it might be an opportunity to contemplate whether or not you should transition the business, because that's not going to get any easier. It's only going to get more complex and more challenging. And then, again, this varies. Some would say this is first. Some would say it's in the middle. But agency culture, like that, it's very subjective, and it's very hard to objectively analyze it. Everything I've given you here, there's pretty objective measurements to it.
Sure.
Agency culture, it's not. So, and the other thing with agency culture, the challenge to it is like, if you're buying an agency and the principal is going to be gone, the culture can be reset. Now, it may take time. It will take time, but it can be reset. So, you won't always be paying for the sins of the past if it was a bad agency culture. But it's a really important factor. If that agency owner is planning to stay, then it's even more important. But that's most everything. I mean, there's a couple other factors, but they're of little lesser importance. Like, do you have a transition plan? Like that is important. It is thoughtful. People will want to know that. But if you've gotten this far, you're at least thinking about it. So, you're listening, you're actively engaging, and you're thinking about it.
Absolutely. So let's dive into IA Valuations. What type of services, like, because we already covered that, you're mostly under the million in revenue folks. Which I think is great, because that's a lot of the merger and acquisition series that we've done before, either talking with folks on the podcast or before the podcast or after the podcast, or they're targeting 2.5 million and up, most of them, and I'm not making that blanket statement for everybody that we've ever had on this podcast, because that's certainly not the case, but that's the majority of them. They're wanting deals that aren't any less than $2.5 million in revenue, so you're million and up EBITDAs. So you guys serve, primarily, I'm sure you'd take somebody on that had a, $2.5 million business, whatever the case is. But you serve, that's your target, which I think is fantastic, because I agree with you that is a really underserved demographic when it comes to acquisitions. So what kind of, besides the transaction itself and preparing it for sale, is that the majority of what we do, or are there other factors that folks can come to IA Valuations for?
Yeah, we actually don't focus on that side of it. That's really, okay. That is the actual sale is it's kind of a secondary part to IA Valuations. Oh. The first thing that we do is we encourage every agency owner to get a valuation. So there are 3 things that we ask every agency owner, or we at least ask them to contemplate it and to seriously consider it. And we believe that they need it. We believe that they should have a valuation. It doesn't have to be an annual valuation, but I do know this: the agencies that we have worked with on an annual valuation outperform other agencies almost, 2 to 1. They are so, but that is a philosophy behind the professional management of these operations. To make an investment on an annual basis of evaluation kind of differentiates them from, probably a lot of agencies out there. But again, I've seen their value grow exponentially, but it's because they're so focused on all of those metrics we've already talked about. And we would go through it in our meetings. Like they think about it every day and they plan for it. But agency valuation, a contingency buy-sell agreement. So most agencies don't have this, but from a planning perspective, we encourage all of them to have it because we do not know when our time may come. And so not knowing that, we should be planned for it. Like there's not a client that, an insurance agent doesn't meet with, hopefully, and knock on, I hope this happens, that every time you're rating their home and auto, you're at least talking to them about life insurance to make sure they have it or they're contemplating or you can get it in their hands. Because again, it's what you do as an agent advisor for your clients. It's the same thing that we try to do with them. Is in a lot of ways, your contingency buy-sell agreement is your life insurance policy. So your family's not put in a bad place if you pass unexpectedly or you become disabled and you can't run the agency. There's someone there that's a safety net to pick up where you left off. And then the final thing is, you should have employment agreements with every single one of your employees. So I don't care if they're licensed or not, you should have an employment agreement with them. They're working for your business. There are some things that you need to have in place that protect your business and protect them. I mean, it's a mutual agreement. It's not just for your benefit. So those are the three things. Our focus really is number one on getting agencies a independent fair market valuation of their agency, because then we can go through all these things that we talked about where we can, share with them. Here are the risk factors. Like let's button these things up. Let's focus on these. We do business planning with them. We'll help them with perpetuation planning. And then finally, it's we'll help, buy and sell. We'll act as a broker on behalf of a buy sell. So we try to bring them multiple potential buyers and get them multiple offers so they have, they can weigh things against each other. So they can then start to contemplate those other factors. Because if all you're after is a number, again, I still think the process helps you, but it allows you to get beyond a number where you can contemplate, how are my clients going to be treated? What's my legacy going to be? Are my employees going to be, retained? Like you can start to put those factors into play versus just playing for a number around what the sale is going to be.
For sure. Well, I appreciate all that. How can folks get a hold of you?
Yeah, so reach out to me, Jeff Smith, OIA, IA Valuations. My email is very simple. It's jeff@ohioinsuranceagents.com. Agents with an S, jeff@ohioinsuranceagents.com. I'd encourage you to go to our website, ohioinsuranceagents.com, or iavaluations.com is another place where you can find us. So we're out there. We're at conferences like the one I met you at the AC in Orlando. We go to a lot of other insurance conferences. And so, again, we're trying to provide a service. We're a unique business model where we're a nonprofit, trade association, business services organization. So, nobody owns the company. It's more service, focused than a private or even a publicly traded company. So that's, again, our focus is, mission-based service for the independent agent. And we want to see the business perpetuated. We want to see, folks that you're serving, that you're talking to every single day on your podcast, have an opportunity to own their own independent business and to grow that, and then, get maximum value out of it. So that's the role we play in this world.
American dream. So what we're all doing every day when we wake up Monday through Friday, right?
No doubt. It's the insurance dream, my friend. That's
it. The insurance dream.
Yes.
Perfect. Hey, I appreciate it so much. Thank you. And we'd love to have you back sometime.
Yeah, man. I'd love to come back another time. Thanks so much for reaching out. It was fun to connect and chat about this.
Yes, thank you.